Hello, everyone. Thank you for tuning in. This is the first episode of the HP Value Investing Show.
Yeah.
And we're doing a video today on, there was an interview with a guy called Jim Rickards, and he is a financial commentator and an author, and has written quite a few books. And he just came out with a new one. And I read several of the books, and I find him to be, he's a very interesting thinker. And whenever you read his stuff, you always learn something new, and you're kind of forced to challenge your views. So there's an interview with him where he talked about this in his new book, which is called The New Great Depression, which is Winners and Losers in a Post-Pandemic World. And in that book, he discusses the impacts of the pandemic. Now, we're not discussing the book in itself. It's not a book review, but it's an interview he had, or if someone did an interview with him, and we're kind of just reviewing that interview and giving our thoughts on it. And my name is Lars Christian Haugen, and I'm here with
Roshni Patel.
Okay, so let's go into the first topic.
So the first part of the interview, Rickards talks about a research paper covering pandemics and the history of pandemics. And the main things to take away from that are that pandemics are nothing new. Going back in history, there have been quite a few pandemics, and since the Black Death or something.
The
Black Death.
650 years ago.
This pandemic that we're in right now would be the third largest. And there were 15 of them in total.
The third largest in terms of death.
Yeah, in terms of death rate after the Black Death and the Spanish flu.
Yeah.
And one of the conclusions of this paper was that it takes around 30 to 40 years to get back to some sort of normality in terms of interest rates, growth, and so on.
And also how people live their lives and how they react, because people will sort of remember this, and it will affect people's attitudes and how they live their lives as well for like next 30 to 40 years.
Absolutely, and probably even longer than that. So this is going to have just a full-blown effect generation to generation. But Rickards is quite adamant that, at least for the next 20 years, interest rates will not go up just yet. And the other conclusion of this point is that pandemics don't cause economic downfalls, it's government policies that do. One particular government policy as a result of this pandemic would be lockdowns. And in particular, Jim says that lockdowns don't work. They don't stop the spread of the virus, but they do destroy economies.
Yeah, and I think our point in terms of, we want to point out that he said they don't work in terms of caseloads and deaths, and we haven't actually done the research on it, so we want to be careful saying if he's right or not. Like, I know that he does a lot of research, and I know he also referred to, in his book that I read already, he referred to research papers from, I think, the World Health Organization saying pandemics don't work, like before this pandemic came along. So that was kind of, people had said that before, like the experts had said that before that pandemic, that lockdowns don't work.
It's an interesting point because, we've been doing lockdown for almost a year now, and so is everyone around the world. And then just to hear that it doesn't work is quite a surprising thing.
Yeah.
So yeah, that's why I find it interesting.
And also because we're talking about, lockdowns obviously affect the economy in such a large way. And we're kind of talking about the economy and the stock market here. So it's worth, when you're talking about the economy and the stock market, and someone mentions that lockdowns don't work, you have to, kind of bring it up to at least put it out there on the table.
Yeah. So it's just an interesting point. It's something that he raised. We don't know enough about it, but we just wanted to raise it because this is kind of a key point
being talked about.
Yeah.
Okay, so we're moving on to, and now we're talking about the current crisis and the stock market. And do you wanna sort of start us off on that?
Yeah. So this crisis that we're in right now, ideally, it should be compared to, or Rickards thinks that this should be compared to the Great Depression, which was back in 1929, as opposed to the financial crisis of 2008, which is a crisis of one particular industry, the financial industry, directly, which would then trickle and impact other industries. So we don't want to compare it to 2008, nor do we want to compare it to the 2000 tech bubble, because the tech bubble in 2000 it was a different situation. There wasn't as much debt as there is today.
And it was like tech stocks going through the roof.
Yeah. And whereas in contrast, what we're in right now would be classed more as an economic depression, because loads of industries are being impacted directly. And then, of course, there's going to be after effects from one industry to another on top of the direct impact.
Yeah. And then also the next point about the stock market.
Yeah.
And how kind of being overvalued. So
that's right. Yeah.
You want to talk about that as well?
Yes, I do. So the stock market and the economy are quite detached. What that means is, consider the S&P 500. They've reached all-time highs in 2020, although that was predominantly, your Facebook, Google, Apple, Amazon, Microsoft, Tesla, Netflix. So, the top 7 stocks, they are like 40% of the S&P 500 by market cap. And sure, they're doing really well in this pandemic, but they are the least affected by it because they're tech companies. They don't have physical storefronts.
Yeah.
Whereas, they don't rely on physical storefronts to make money, and therefore they weren't affected by the lockdowns.
Yeah. So you see the real economy is kind of going down the toilet with, let's say hairdressers,
Yeah.
or, any just normal storefront is doing poorly. But then these biggest tech companies, they're going up. And that looks like the stock market is really booming,
Exactly. Whereas, more of your everyday companies, your small and medium enterprises, they form around 50% of the economy. And they're the industries and the storefronts that are suffering. But unfortunately, people on, Wall Street and people who will watch news, they're not going to pay attention to that because that's not the interesting news. And a lot of these small and medium enterprises, they're not listed either. So that kind of news is not going to be very visible.
Yeah.
It's easy to look at Tesla and see the news like, oh, it's going up 700%, 800% last year, and think, yep, like you said, stock market is going fantastic. But it's the SMEs that people are not paying attention to. They're the ones that are really suffering.
And they're the ones that really drive the economy.
Yeah.
All right, so then we're moving on to the topic of a new monetary theory, because in the interview, Rickards talks about the fact that in the US, the Fed sets the interest rates and they print money, basically. And the way it works, that the Fed and the government is generally separate. We don't need to cover exactly how the mechanism works, but it's kind of the idea is that the government has to, borrow money, and sometimes the Fed prints the money. Excuse me, if they, if the government, if they can't afford it, if they're issuing more bonds than they actually take in taxes, like sometimes the Fed needs to come in and print money and push more money into the market. But they've always been kind of separate. But now there's kind of like this new theory emerging that says that, why you don't have to have them separate. The banking system was in the middle, usually between the Fed and the government. Kind of, they were the kind of the part in between.
Yeah.
But now the new advisors to Biden are saying, you can just cut that out and you can just combine the two.
Yeah.
So then you can literally just directly finance the government with, or the Fed can just directly finance the government, because they're thinking, well, if the Fed is printing money and the government needs to borrow money, as in borrow dollars, and they're printing dollars, they can just print it and give it to them directly. And before, that was always kind of, whenever you said, oh, we need to spend more money, the government needs to spend more, people would say, oh, we can't afford it. And people go, yeah, that's kind of true. You just can't just spend, trillions and trillions. But that's kind of where we are now. It's like, we need to spend trillions. So that's what people are saying, especially after the pandemic. This isn't something new. This has just been ramping up, especially after 2008. And you can just kind of see that the government debt and also the Fed balance sheet has been increasing a lot as well. And Rickards points out that yes, you can do it technically. You can combine you can kind of combine the Fed and the government and just print as many dollars as you want, and then just finance the government directly. Like it does actually work from a legal perspective. However, there is this confidence boundary, because you can't just do that forever. You can't just spend as much money as you want forever. Like there's no free lunch. Eventually this will come home to haunt you. Like as any normal person just can't keep borrowing. Like eventually they have to pay back. And if you print money, like yes, you can finance the debt straight away, but what you eventually get is you get, potentially a loss of faith in the dollar, because the dollar will be devalued a lot.
Yeah.
And as we talked about in an article we published recently on why we invested in gold, is that if you do that, you devalue the dollar, you kind of destroy it, and then that really hurts the society. So you might be able to finance your government debt at the moment, but then you have to pay the bill at some point in the future. So that's kind of the idea, that the point here is that people are just thinking now that you can just print as much money as you want. And Rickards is saying that's very dangerous, because people might lose faith in the dollar, and that bad things will come from that.
Another point that we want to talk about here is gold. So Jim mentions 3 factors that drive gold, and the first one being the fear trade, so geopolitical factors. Second one, supply and demand, and the third one, interest rates. We also wanted to bring in a fourth one, which is money printing, and we've already just spoken about that. Already,
because we wrote an article about it, so we
got so you can't exactly miss that. So to go back to those initial 3 points, the first 2, fear trade and supply and demand, are supporting gold prices. There are some geopolitical factors that will be supporting gold. So for example, the situation with Iran. And what this means is that anytime there's fear in a geography, then people rush to gold. And then the second point, supply and demand. There's a stagnant supply of gold, but the demand is still high. And then the third point, interest rates. We would say that they're crushing gold right now. Why? Because people think that lockdowns will end and the economy will eventually grow. And if an economy is growing, people anticipate inflation. If people anticipate inflation, then interest rates are expected to go up. That's basically the argument, right? And high interest rates mean that people would rather buy bonds and so on than invest in gold. And that's why we would say interest rates are crushing gold.
Yeah, high interest or high real interest rates kind of they lead to they lead to the gold price going down, and now kind of people are expecting real interest rates to go up, so that's why gold is kind of being crushed at the moment. And then what he's pointing out is that maybe that probably in the short term for the next 3 to 6 months, but what he's saying is that as we just mentioned earlier, that half the economy is doing poorly, and there's going to be a lot of stimulus, but even if that comes, the half of the economy is still doing very poorly. So you probably won't get the inflation that you think you're going to get. So that's what he's saying. Like, market is expecting inflation, it probably won't come. That's why gold is doing poorly at the moment. But then once the market realizes the inflation won't come, then gold will probably go up again, and interest rates will go down. So that's kind of the main point, because Rickards is quite knowledgeable about gold.
So during inflation, gold does really well, but it also does well in deflation.
I would say more higher inflation. Sorry to interrupt, but it's kind of because we just talked about when inflation goes up, real interest rates go up, kind of that thing. But if there's if inflation goes out of control, then gold is good. So it's kind of, if it's a happy medium, so everything is good, then gold does poorly. But it's like high inflation or deflation, then gold does well.
I think that makes sense, because when you're thinking inflation, that's loads and loads of inflation or hyperinflation, that means lots of money printing, and then the purchasing power of that money goes down. And that's why people go to gold.
Exactly.
Right. So that covers inflation. So with deflation, why does gold do well with deflation? It's because governments hate it and they will do anything to avoid deflation. And why is that, you might ask? Or that's why I asked, at least. Because governments don't have cash, they have debt. So if deflation happens, then it would be really hard for the government to pay back debt with a deflated currency. And plus, deflation slows down the economy, and nobody wants to deal with that aftermath. And as a result, you get governments just kicking the can down the road, and they don't want to pull the plug and let deflation happen.
They don't want, no one, if you're the Fed or in the government,
Yeah.
you don't want the economy to be contracting on your watch. You always want the economy to be growing.
Yeah.
And that's what they want. That's why they say, oh, inflation is good. You want inflation. And, as you said, to your point about the debt, if they have a certain amount of debt, but then there's deflation and the amount of taxes they take in goes down, then it's more difficult to pay off that debt. And so I think one point too about deflation is that they hate deflation. And therefore deflation actually leads to inflation.
Yeah.
So it's good for us. So deflation leads to inflation, which is then good for gold. So it's kind of like inflation or deflation.
And that's just because deflation cannot allow that to happen, and then more money just gets printed to try and solve the problem.
Exactly. All right, and then the last topic that we want to talk about is the US dollar as a reserve currency. Now, we just mentioned the fact that, if the Fed and the prints too much money and the government spends too much, then that might weaken the dollar and, people lose faith in the dollar. But then the question on the other hand is, well, the dollar is the world's reserve currency. And then people ask, well, is the dollar sort of going to just disappear or not be the world's reserve currency? And Rickards points out, I guess at least in the short to medium term, is that it's not going to lose its reserve currency status straight away, because the US is the biggest bond market in the world, US government bonds. And when other countries, let's say China, hold reserves, they need to hold it in something. So they buy, for example, US government bonds.
Yeah.
And that's the biggest, most liquid market. So that's why it makes a lot of sense for them to, or for the US dollar to still be the reserve asset. So, don't expect the dollar to just sort of really go down and tank. And Rickards also points out that you're looking at when you're looking at the dollar, you're looking at it compared to other currencies. And if the dollar goes too much down compared to the euro, it means that the euro is strengthening. And then when the euro is strengthening, that means that they can import deflation, because they're buying things on the cheap. And then, as we just mentioned, governments don't like deflation. Even though it's good for people who live in Europe, who have euros and they can buy things cheaper. But deflation might stall the economy, or just kind of, governments just don't like it at all. So they don't even want to hear deflation. So that's just an interesting point to bring up, the fact that don't expect the dollar to just sort of go anywhere. In the necessarily in the short term.
It's too interconnected with lots of currencies. And we had a brief discussion about this yesterday. It's just that, if you're going to buy oil or other commodities or other goods, it's most likely to be traded in US dollars,
not even just most likely, it is it's the petrodollar, it is traded in dollars. I mean, you're right, actually. I'm sorry, you can do it in other things. I think there's been instances where they trade in gold, but most likely in dollars.
And that's what we mean by more liquid currency.
Exactly. That's what the world uses. And then just one last point, bringing back the gold thing, is that that's what Rickards mentioned, is that the currencies are sort of, they can go up and down compared to each other, but they're all at the same time going down against gold. So sort of the gold is like the thermometer telling you, is the patient getting sicker or not? And seeing gold going up to 2,000 last year, sort of, you can sense that there's something going on in the market. So
just to summarize what we've covered in this video, we've looked at how serious the economic impact of the pandemic is on economies around the world, and that the after effects might be felt for decades. We also looked at how the economy is being crushed, especially small and medium enterprises compared to your big tech companies, and the stock market, is not discounting that, i.e., that's the stock market isn't really focused on the small medium enterprise, because that's not the sexy news.
And then we talked about the new monetary theory of MMT. That's kind of like changing the kind of the monetary landscape now, and how they might lead to further down the line, a loss of the faith in the dollar, or at least the dollar going down against gold. And then we did talk about gold long and short-term outlook, saying that short term is probably going to be a bit weak, but over the long term we think it's a good investment, or at least a good portfolio hedge. And then lastly, just mentioning the kind of the even though the dollar might be losing value, it's still, as reserve currency, it's going to be around, because a lot of people just think that it's going to lose the reserve currency status, and the US is just going down the drain. But that's a bit too dramatic.
Yeah,
in our point of view.
It's not that easy just to be like, right, we're done with the US dollar.
No, exactly. Yeah. So I guess that brings us into, we kind of summarized everything and said, summarized the video. So how about maybe just kind of bringing it all together, sort of giving our view on this, because that's why we wanted to look at the video, because we want to, give people our opinion on it.
Yeah, absolutely. So why did we look at this video? It's an interesting topic. We're in a very strange situation these days. We're in a pandemic, and the topic of the video, which is the pandemic and what it could mean for the future, is so relevant to this day and age. So I just need to pause for a moment. I was thinking about what to say next.
Say something smart.
Economies and businesses, a lot of industries are in economic trouble. However, the stock markets are still going up. So that's quite strange right there.
Yeah.
We're not fear-mongering. We don't want to try and time when the next stock market crash is going to happen, but it's very important to be aware of what's happening right now and just be prepared. Think about what we want to do next.
Yeah. I think just to kind of add my 2 cents at the end, like just reiterating what you said, is just, this is a time to be cautious, because the economy is going one way, but the stock market is going another way. And we're not predicting a crash or doom and gloom, but it does look like, there's going to be some, that 2021 might be very tough. And I just think it's important to mentally prepare for that, and then just not just invest all your money in the stock market. Like what we're doing, we're holding some gold, we're holding some Bitcoin. We think those are good hedges. We still hold stocks. We're still on the lookout for stocks all the time, but it's a bit difficult to find them because they're quite expensive at the moment. But then also holding a lot of cash and just being patient. So again, as you said, not fear mongering, just saying, this is a time to exercise caution and just kind of think about what the outcomes might be going forward.
Yeah, and just a little final disclaimer. We're not saying you have to go off and do exactly what we're doing. We're just saying that this is how we're preparing for the situation.
Exactly. Cool. So that's it. Thank you for tuning in. Yeah. And I guess, sorry. Yeah,
I was going to say, just, I hope you like this, or we hope you enjoyed this.
And one last thing that we forgot to mention at the beginning, if they want to follow us on the eToro. We have an account on eToro. So that's a trading platform, a social platform where you can follow people. And we just started an account called HP Value Investing, where we want to invest, and people can look at what we're doing. We just started, so we only made 3 investments, but the plan is to keep doing more investments going forward when we find the opportunities, and kind of build off there. So people who are interested in following us can go there.
Yeah. And also by following, that means copying our portfolios.
Yeah.
So the way that works is click a button, and then whatever trades you do will mimic what we're doing. It's quite a nice, easy way to follow our strategy.
Yeah. Please like and subscribe and all that stuff. And thank you for tuning in.
Until next time, goodbye.
Bye.